While America was asleep, silver didn't just fall, it was wiped out. No headlines, no warning. One quiet overnight move erased billions and blindsided investors worldwide. This wasn't random, and once you see what triggered it, you'll understand why this crash could be just the beginning. Lock your screen. Silence your world. What you're about to witness is not a market update. It is an autopsy of a financial ambush. While you slept in the early hours of January 30th, 2026, a silent weapon detonated in the global financial system. The result? Absolute carnage. Silver, trading at a staggering $9,146 per ounce just hours before, was eviscerated, crashing over 14% in a single violent session. Gold plummeted by nearly $354. Platinum and palladium were gutted. This was not a routine pullback or a healthy correction. This was a calculated liquidation event, a $1 trillion wealth transfer executed in the dark. And if you do not understand the mechanics of this midnight massacre, you are destined to become its next casualty. The financial media will chatter about industrial demand or mining outputs. They are describing the weather during a hurricane. The real storm, the invisible force that just wiped out leveraged portfolios across the globe, operates in the shadows. It has a 3-letter name, DXY. To understand this, you must first step inside the machine. Picture a colossal, unforgiving seesaw on a global scale. On one end sits the US dollar index, the DXY, a measure of the dollar's strength against a basket of the world's other major currencies. On the other end rest precious metals, gold, silver, and their kin. They are locked in a fundamental physical dance of opposition. When the dollar rises, metals must fall. When the dollar weakens, metals surge. This isn't mere correlation, it is mechanical causation, the iron law of dollar-denominated assets. Every ounce of silver you buy is priced in dollars, so when the dollar itself becomes more valuable, it takes fewer of those dollars to buy the same ounce. The price collapses. This is the foundational truth that most retail investors sleep through. Yesterday, the seesaw tilted with devastating force. During New York hours, the DXY spiked. Silver was crushed, plummeting from over $121 to a breathless $1,680. Then, a deceptive recovery. It clawed back to nearly $11,730 by evening. A collective sigh of relief echoed through online forums. Dip buyers piled in, leverage was added, stop losses were set with false confidence. They watched the silver chart alone, seeing a rebound. They were blind to the DXY, which was merely gathering energy for its next strike. Then, New York closed. America went to sleep. The Asian session opened, and the weapon fired again. In the dead of night, Eastern Time, institutional algorithms, watching only the DXY, detected another violent surge in dollar strength. Automated selling programs triggered instantly. A cascade of sell orders flooded the electronic exchanges. Silver, which had settled at $118.58, was blitzed. It crashed to $95.18, a 19.7% plunge in the overnight session alone. If you were holding a leveraged position, if you thought $100 was an unbreakable floor, you were financially obliterated before your first alarm clock rang. Your stop losses were not safeguards. They were neon signs for predatory algorithms, signaling exactly where your breaking point lay. Your capital didn't vanish into the ether. It was systematically transferred to the entity on the other side of your forced trade, the cold, patient capital that saw this coming because it watches the seesaw, not just the seat. This is the brutal game. The institutions do not just trade silver. They trade the relationship between the dollar and silver. They obsess over the DXY's every tremor because it is a leading indicator. It tells them what silver will do before silver does it. The retail trader, fixated on a flashing price chart, is driving by looking in the rearview mirror. By the time the red candle appears, the accident has already happened. The overnight carnage of January 30th was not an anomaly. It was a perfectly executed trap springing on the unprepared. Your portfolio wasn't a victim of bad luck. It was harvested. But what happens next will change everything. Because this trap has a specific repeating pattern. And the final, most devastating squeeze is being set up right now, hinging on a single calendar date. What you do in the next 72 hours will determine whether you are harvested or become the harvester. The collapse wasn't random. It was the predictable outcome of 3 compounding forces, each acting as rocket fuel for the US dollar. To see the next move, you must understand these engines of strength. First, the Hawk's Gambit. The Federal Reserve has shed its dove feathers. In a world begging for rate cuts to soothe aching economies, the Fed is holding the line, its rhetoric sharp and unyielding. It is prioritizing the slaughter of inflation above all else, even at the risk of economic pain. Higher U.S. interest rates act as a global capital magnet. Why park money in euros or yen yielding little when you can convert to dollars and earn a superior return in treasury bonds? This relentless conversion, yen to dollars, euros to dollars, creates torrential buying pressure for the currency. The DXY rises. And as the seesaw tilts, metals are crushed under its weight. This isn't theory, it's hydraulic financial physics. Second, the flight to a fractured sanctuary. When global fear spikes, capital seeks a safe harbor. For decades, the unquestioned sanctuary has been the US dollar. But now, the sanctuary itself is under construction, surrounded by scaffolding and political chaos. Yet, in a panic, the herd still stampedes toward it. As I speak, geopolitical tripwires are everywhere. Escalating Middle East conflicts, live fire drills and critical oil choke points, and the drumbeat of trade wars. Each headline injects a jolt of fear. That fear manifests as a frantic scramble for dollars. This demand artificially inflates the currency's value, further tilting the seesaw against metals. Silver becomes a casualty of fear, even as it is supposed to be a refuge from it, a cruel paradox. Third, the dragons sneeze. China, the world's industrial engine and largest consumer of physical silver, is coughing. Its economic data is faltering. Stimulus measures are hesitant. When Chinese manufacturing contracts, forecasts for industrial silver demand are slashed. This fundamental weakness pulls down the metal, but it also creates a secondary, more powerful effect: capital flight. Global investors pull money out of Chinese and Asian assets, seeking stability. Where does it go? Back to the dollar, reinforcing the first two forces. It's a vicious, self-feeding cycle. Fed hawkishness and global fear attract money to dollars. Chinese weakness pushes money away from alternatives, and the dollar fortress becomes ever more impregnable. For now, this is the triad that orchestrated the overnight massacre. But here is the critical, overlooked pattern. This violent DXY spike and metallic collapse is not new. It's a rehearsed play. Rewind to December 25th, 2025, a similar crash, liquidations, panic, then a spectacular January recovery with silver soaring 65%. The script repeated on December 31st, crash, then another explosive rally into late January. Each time the catalyst was a sharp DXY spike. Each recovery began when the dollar's strength finally ebbed. We have now witnessed the third act of this play. The pattern is clear: crash, recovery, crash. But the final scene is always the most dramatic. And now the trap is set for the climax. The hinge point for everything, your survival, the next mega rally, or the final wipeout, is a single event: the imminent US government shutdown deadline of February 1st, 2026. This is where narrative control of the dollar will be violently wrestled over. And this is where the video takes a shocking turn. Because what happens in the 48 hours after a shutdown is the exact opposite of what most expect. A hidden psychological flip will occur that could erase the dollar's gains in an instant and launch metals into a stratospheric rally. Most people never hear the next part, and that's the real danger. Let's dissect the shutdown scenario, because within it lies both extreme peril and generational opportunity. The immediate reaction to a government shutdown will be primal fear. Headlines will scream dysfunction. Uncertainty will skyrocket. In this initial 48-hour window, the herd instinct will take over. Flee to safety. Buy dollars. The DXY will spike violently. Silver and gold will be crushed, likely testing lows far beneath where they are now. Margin calls will echo through the system like cannon fire. This will be the valley of the shadow for precious metals holders. Weak hands, those using excessive leverage or trading on emotion alone, will be obliterated. Their forced selling will deepen the crash. This is the liquidation cascade. But then, the psychological flip. Approximately 72 hours in, a new narrative will begin to crystallize from the chaos. The story will shift from "the world is scary" by dollars to "the institution backing the world's reserve currency is fundamentally broken." Foreign central banks and sovereign wealth funds will look at the political paralysis and ask a dangerous question. Is this still a reliable foundation for our reserves? The dollar's value is not just in its interest rate. It's in the perceived stability and competence of the system behind it. A prolonged shutdown shatters that perception. Capital will not just stop flowing in, it will begin to flow out, seeking alternatives. The DXY will reverse its gains with ferocious speed. And what is the historical alternative when faith in fiat currencies erodes? Precious metals. The seesaw will not just tilt back, it will slam downward on the dollar side with equal force, catapulting silver and gold into a parabolic ascent. This pattern has precedent. During the 2013 shutdown, the dollar saw an initial spike, followed by a sustained decline as the embarrassment set in. The 2018 brinkmanship played out similarly. The market's memory is short, but its reflexes are programmed. So you face two paths. Path A shutdown is averted. Relief washes over markets. The dollar weakens gently, metals rise steadily, a smoother climb toward higher ground. Path B, a shutdown occurs. Brace for 48 hours of sheer terror in metals, a gut-wrenching plunge to shake out every last leveraged speculator. Then, the whiplash reversal. a historic buying opportunity as the dollar's weakness is exposed, launching the mother of all rallies. Both paths, critically, lead to the same destination, significantly higher metal prices by mid-February. Path B is simply more violent, more treacherous, and ultimately more rewarding for those who survive the initial onslaught with capital and conviction intact. This brings us to your only true enemy, leverage. The overnight wipeout was a masterclass in its dangers. Leverage is borrowing confidence from your future self. When silver dropped 19.7%, a 5x leverage position was annihilated. The holder didn't choose to exit. They were forcefully evacuated by their broker's algorithms, their sold position becoming cheap fuel for the next rally. They provided the exit liquidity for smarter, patient capital. If you must use leverage now, you're a tightrope walker in a hurricane. The goal is not just to be right on the thesis. It is to survive the volatility until the thesis plays out. To those holding heavy, unrealized losses right now, sick to your stomach, understand this. Every monumental bull market in history is paved with correction headstones. In 2008, silver lost over half its value. By 2011, it had multiplied fivefold. Your mistake may have been one of timing, not of thesis. The structural drivers, runaway industrial demand in green tech and AI, shrinking supply, and the slow global erosion of faith in paper currencies, are intensifying, not diminishing. The question is not if the tide will return, but if your psychological boat can remain upright until it does. Here is your survival watch list for the next 72 hours. The DXY ticker. This is your radar. Its direction dictates all. The February 1st deadline. The binary trigger for the next seismic shift. Federal Reserve speech. Any hint of shifted tone will move the dollar. Chinese policy. Response. Signs of major stimulus could soften the dollar's edge. Today's carnage was a filter. It separated the gamblers from the strategists, the emotional reactors from the cold analysts. It transferred wealth from those who watch only price to those who understand cause. The dollar is the weapon. The DXY is the trigger. February is the battlefield. When the dust settles, the only players left holding the keys to the next fortune will be those who saw the crash coming, understood its mechanics, and had the fortitude to see it not as an end, but as a brutal, necessary reset. Be that person. This is Economic Tales. The story of money is a tale of psychology, power, and patterns. If you want to stop being a character written into someone else's script and start writing your own, your journey begins with understanding. Subscribe. Dig deeper. The next chapter is already being written.